Hello, this is Ken Tomko with our monthly review of what's going on in the markets, what we're doing in our portfolios. As always, please don't use these for trading purposes. They are for educational purposes only. I'll always start here with a weekly chart of the S&P 500, give us the very big picture. It just goes back about 6 years. This is 2019 here on the left side, and still just have the last bit of the COVID sell-off there in 2020 in the chart. And then the long rally afterwards with the Federal Reserve and the federal government pumping all the money into people's pockets took us up to highs. And after that, here in 22, the Federal Reserve started tightening interest rates, raising interest rates to sort of head off inflation a little bit. And then in 23, as it looked like they might have been done with that process a little bit, perhaps. Now we're off to the races again. And as you can see, the S&P 500 is off to all-time highs in recent weeks, and even you see here the trend line that I've drawn onto the market. Boy, we've gotten even quite a bit far away from that. I mean, we'll look at this rally that we've had over the last 6 months, rather unexpected to many, but here we follow what the markets are doing, and as we started the uptrend, we pointed out that it was in an uptrend, no matter what you saw on CNBC, that this was what was happening. And so we got invested through this, which is great. But it does look a little overextended. But I'll just say that we are in a long-term uptrend for sure. If we come down here to next chart, this is our daily chart. Gives us about the last 2 years of trading. And we can see the rally that came off some right around Thanksgiving. It's just been up, up, up and away. Incredible. We finally saw some little cracks in the armor earlier in the last week or two. Sure, we broke the trend line there in the daily, but we really didn't get past any support. So it hasn't really broken down per se. It's certainly giving us a little pause. And now we haven't really gone anywhere in the last month or so. But nothing too bad has happened yet. And if we come down here to a little shorter time frame, this is a 2-hour chart. Every one of these candlesticks is 2 hours. This gives us about the last 6 months trading on the S&P 500. You can see the channel I've highlighted here as we were going up, 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 just nice and steady, just kept bouncing off and all the way through. And sure, it's broken that channel now, but it's actually moved, and I put up here into sideways action. So I wouldn't call this a downtrend yet. It might just be that we're pausing here for a month or two before moving on. So nothing has happened quite yet. Probably the impetus for that happening, if we come over here to the, this is the interest rate for the 10-year Treasury. And you can see here that the interest rates have been just coming up, up, up over the last couple of years. And then as we started that rally late in the year, that was from interest rates falling. Well, now we are kind of seeing interest rates accelerate again as we're getting some hotter inflation numbers, and it may be that the Fed is not going to be pausing or cutting interest rates anytime soon. So wouldn't be surprised if that raising of interest rates right there leads us to some further downside. Don't want to predict, and it hasn't happened yet, but something that we'll be watching closely for. I did want to go back here to the 2-hour chart and go through some of our internal measures as we go sideways up here. This first one is the percentage of the S&P 500 that's in an uptrend, and currently it's at 63%. And as you see, it's just been kind of declining this year. So as we're hitting all-time highs, what we're seeing is only 63% of the index is actually in an uptrend, which is not the healthiest thing. It's not terrible. We're not down here at the 23 where you saw the sell-off from last fall, but that is a little troublesome that as we get higher, it's just a few fewer and fewer stocks that are holding up the index, as I pointed out in our last video. This is the advanced decline line for the New York Stock Exchange, and as you can see here, it's I mean, it still keeps moving up, but it's kind of flat. It doesn't look like there's a ton of acceleration and breadth to the rally that's happening. And then finally, at the bottom here, this is the VIX, the volatility index. This is what people are paying for protective puts for their portfolio, options to protect it. And it's a little elevated right now, but not really giving too much information. It kind of looks a little more sideways the last 3 months. So, and that is what we're seeing here. We're seeing a little bit of a sideways action, and we'll see that if this rise in interest rates here starts to impact and the equities, as I suspect it might as we go a little higher there. We look at the economic picture. This is from Trading Economics. Go on here and has all this data here for you, and GDP growth rate. As you can see, the GDP growth rate numbers, they're actually quite good. We're still showing growth in the economy. So the talk of the recession, it hasn't hit yet. We're not seeing that data. It certainly could, but we're not seeing that data yet. In terms of payrolls, here we go, where it's 303,000 was the last reading. Also good. Inflation rate, it's moderate. We're not at the 8 or 9% that we had. We're sitting there in the threes, so that's good. And then finally, if we come over here to retail sales at the bottom, they're still positive. I mean, everything that I'm seeing here on the economic side is still good. There are definitely some reasons for concern that much of this might be driven by just government spending. That's where some of the payrolls are coming from. But until it actually shows up, we can't. We don't want to be predicting. We just want to follow what we're seeing in the data. If we come here to the, this is the forward earnings for the S&P 500, analysts' prediction of what the earnings will be going out here. This is Q2 of next year, 25, and you can see they're still predicting that. So overall estimates for analysts are saying, hey, still going to be good earnings for the S&P 500 going forward. And finally, if we look here at valuations, the S&P is at 51, 53. If we come here to a 20 times earnings valuation, it would have the market at 38.48, which would represent over a 20% decline from these levels. So don't kid yourself. It is a bit expensive right now. Certainly, we could have higher earnings and grow our way out of that, but the bottom line is it is very expensive right now. So overall, what we're seeing, again, we're in a great big uptrend, and the market, even in the last couple of days, as we had a little pullback, it seems to be buying the rallies and staying with it. So how long that lasts, I don't know. But right now, sure, stay invested, maybe a little bit cautious, or some people that maybe had a big rally from the last 6 months may say, hey, you know, I still want to put, I could put some money away in a 1-year treasury that's paying over 5%. So that kind of thing still is happening, and we are a little extended, but invested for the time being. So hopefully, hope this was helpful and informative. I'm going to put up our contact info here. If you have any questions, would like to hear what we're doing in our portfolios, or have any questions you'd like to see addressed in future videos, please don't hesitate to reach out. And in the meantime, have a great day, and we'll see you at the next update.